Equity Mates.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Welcome to another episode of Equity Mates, a podcast that follows our journey of investing. Whether you're an absolute beginner or approaching Warren Buffett status, our aim is to help break down your barriers from beginning to dividend. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
I'm very good, Bryce. I'm very excited for this interview. We have done a lot of industry deep dives in our time on Equity Mates, but one thing that we've spoken about is doing more country deep dives or continent deep dives, and really getting to understand different parts of the world a little bit better. Like investing is truly global now. We've spoken a little bit about Europe on our AusBiz TV show.
Yep.
But today we're going to be doing a deep dive on our closest neighbour and probably one of the more exciting regions in the world, and that's Asia.
That is Asia, and we have an expert in the studio to help us through it. We would love and very happy to welcome Mary Manning. Mary, welcome.
Thank you very much for having me.
So for those of you who haven't come across Mary before, she is the portfolio manager at Ellerston Capital for the Ellerston Asia Growth Fund, Ellerston Asian Investments, which is available on the ASX. The stock ticker is EAI, and the Ellerston India Fund. Prior to joining Ellerston, Mary spent 5 years at Oaktree Capital Management, the famous firm co-founded by Howard Marks. Mary also has an MBA from Harvard and a PhD in economics from Sydney University, and is one of Australia's foremost experts in investing in Asian markets. And we're going to be unpacking it all today. So very excited, Mary.
Great. Thanks so much for having me.
Very impressive CV. I don't think we could have got anyone better to help us unpack Asia. Before we get into the continent and the investing opportunity there, we have a couple of introductory questions just to get to know you a little bit better. And where we like to start with these interviews is the story of your first investment. We generally find there's a good lesson or a good story that comes out of it. So to kick us off today, can you tell us the story of your first investment?
Yes, absolutely. It's quite interesting what my first investment was, because it has kind of been a precursor to my whole career investing in Asian and emerging markets. So when I was in business school, this was late 1990s, I did a summer internship in Beijing. And I worked at a company that was called VC China. It was one of the first VC companies in all of China, and it just helped Chinese entrepreneurs try to get off the ground. And we worked in an office that had no landlines. And everybody had a mobile phone, and some people actually had two mobile phones. One was their work mobile phone and one was their personal mobile phone. And most of the entrepreneurs that we worked with, they didn't have real offices either. They were kind of, on the go, and they had one or if not two mobile phones. So my first investment was actually China Mobile. And if anybody who's listening is one of my investors in my fund, don't worry. Now I do much more work on the companies in which I invest. But at the time, literally that was my analysis, that there are more than a billion people in this country, and they all are going to have at least one phone. And so the math was pretty simple. And, China Mobile was kind of the only way to play that. China Mobile at the time had an ADR and still does. And so as an investor based in North America, it was easy to buy. I think we can get into it later in the show, but that's one of the issues people often have with investing in Asia and some of the different countries in Asia, is that it's harder to invest. You may need a different account, or there's different tax implications or something like that. China Mobile was super easy, had ADR, so I bought it, and I held onto it for about 5 or 6 years. So that was my first investment, and it's quite interesting that now I spend almost all my day looking at stocks in China and elsewhere in Asia.
And just for people who heard the acronym ADR and aren't familiar with it, it stands for American Depository Receipt. Can you just quickly explain what that means and how it allowed you to invest in a Chinese stock? Yeah,
absolutely. So Chinese stocks or stocks that aren't from America can list in America as ADRs, and they can list on NASDAQ or whatever exchange. But then you just buy it like it would be an American stock, but it's domiciled elsewhere, and its revenues and earnings come from elsewhere. But it's very easy because it's just like any other U.S. stock. So some of the biggest stocks in the world, like Alibaba, for example, has an ADR. A lot of stocks have ADRs because it just makes it easier for them for people to invest in them.
Mm. So, Mary, you have worked at some of the best funds in the world for some pretty legendary investors, George Soros, Howard Marks. What have been some of the major lessons that you've taken from these investors?
Yeah, it's a good question, because I do feel very blessed to have worked for these kinds of, iconic investors, and certainly at the beginning of my career. So I guess working at Soros, one thing that I So, I wasn't like sitting across the table from George.
going to lunch with him.
Oh, no, yeah, exactly. I was down the hall from him. But I guess he obviously made his money, shorting the British pound and breaking the Bank of England was kind of his signature trade. And those don't come along very often. So I think one of the main things that I learned working there was the benefit of having a big worldview. So the first time I actually met George was not in the office. It was at the Council of Foreign Relations in New York, which is an organization, and they bring in world leaders, and you have to, your firm or you as a person have to be a member of it. But it's very high level. Like, at the time I was doing it, Thabo Mbeki was the president of South Africa. So you just go and meet him, Mbeki, like these kinds of things. So I actually met him there before I met him in the office. And then I introduced myself. I said, actually, I work for you. and so just to sort of meet, to know that at his age at the time, which was already, 60 or 70 probably, that he's still so interested in world events and had such a big worldview. I mean, he's an iconic investor, but he has done a lot of intellectual thinking about like theory of reflexivity and about open societies. And he has his whole philanthropic, just the ability to be a big thinker, but then take those very high level thoughts and crystallize them into a trade that makes money. I think that is an amazing skill to have. Very few people in the world have that. People are either at the 30,000 foot view brain, or they're at I'm a tactical, I have a tactical brain and I'm making the trades. So to be able to marry those two and have exposure to someone like that earlier in my career was really important. Working at Oaktree, I guess I'll say two things. One is just, again, Howard Marks' brain is amazing. So again, I wasn't sitting across the table from him, but I'll give you one anecdotal evidence. So I actually worked at Oaktree in New York, and then I left for 3 years and I did my PhD, and then I went back to Oaktree in the Singapore office. And at one time, Howard came to visit the Singapore office. There was only about 10 of us, so we all went out for lunch. And I was sitting next to him, and I'm thinking, oh, good heavens, what am I going to say for the entire lunch to Howard Marks? And so I mentioned, I just finished my PhD and now I've come back to the firm. And he was like, oh, what did you do your PhD on? And my PhD thesis was totally random. It was about like African economic development and the impact of epidemics on, health. And his intelligence is so like both deep and broad at the same time. I've heard that like Bill Gates is similar. Then instead of saying, oh, that sounds pretty random, on to the next thing, he's like, well, what were your thesis conclusions? Well, what does this mean? Well, what does this mean for healthcare? And just having the intellect to be able to have a topic that he probably knew absolutely nothing about. And he kind of got the whole gist of what I just spent 4 years analyzing in about 2 minutes. And so just to have exposure to people who have that sort of intellect is really important. I think the other thing that Howard is amazing for is taking the firm on a journey. So when I first started, Oaktree was a very established firm, but over the time that I was there, the firm doubled. And then they, expanded around the world. So they had Los Angeles and New York and London and multiple Asian offices. And then they did sort of a backdoor listing. And then they did a full IPO. And then he sold the company. So from a wealth generation perspective, there's a lot of people who are good investors, but they actually don't do a very good job of running their own firm. And I think that Howard Marks is a amazing example of someone who can do both: invest in other people's companies and use all that knowledge that you use to make good investing decisions to actually do it himself.
Wow, a lot to unpack there. I think the first thing is you have to be incredibly smart, but then it also sounds like they're both incredibly curious. Howard wanted to learn about your PhD thesis. George wants to learn about things outside like the investing niche, and I guess they're constantly trying to learn more.
Yeah, absolutely. And I think that's important. It has had implications for my career. And it's probably one of the reasons why I really like doing emerging markets and like investing globally, is because there's always something new to learn. And there's always something going on in a corner of the world. And it's obviously, often very important to that corner of the world. And so I feel like I've never been bored a day of my life in this career, because there's always something to learn. And I think having those people as examples was good to have early on in my career.
So you've worked for some of the best investors in the world. You've done a Harvard MBA. You've done a PhD at Sydney Uni. Throughout all that experience and all that learning, have you developed a personal investing philosophy?
Yes, absolutely. So I'm a growth investor, and stylistically, I am a growth investor, and that aligns very nicely with investing in certain sectors and in certain regions. So Asia is an amazing structural growth story, and so for me, finding high growth companies in the best structural growth story in the world is relatively easy. I also my favorite sectors, or the sectors where I have expertise, are technology, consumer, and financials, and those are also growth sectors. So I am definitely looking for growth. And part of that, the first firms that I worked for in investing, or certainly when I was buying China Mobile, that I didn't start from day one with that. It was something that was formed over time. And one thing, if your listeners are interested, one thing that really helped me crystallize my thinking about being a growth investor was just actually crunching the numbers. So I worked I was actually at Ellerston when I first started there, and the portfolio manager that I worked for, you had to get 50% upside to be able to pitch a stock.
Wow.
And so in markets, particularly developed markets, to get mispricing of 50% is very hard. Like, markets are efficient, and as you guys know, technology is making markets more efficient every single day. So to say that there's a stock out there that is where the multiple is 50% mispriced is very rare to find. So if you're an analyst trying to find 50% upside, working backwards, you figure out very quickly this stock is going to have some growth. If it has some growth and the multiple is maybe a little bit off, I can get my 50% upside. If it has a lot of growth, I don't even need any change in the multiple at all. It can just grow to its 50, it can compound to its 50% upside over a few years. And so that really, for me, that discipline of having to find a certain amount of upside and realizing I'm not going to get there in efficient markets without growth really sort of drove me into the growth corner. So that's my style in terms of investing, but your question was also about philosophy. So I think, my philosophy as an investor is that, number one, I have a fiduciary duty. And so this is not about having fun or it's interesting. Like, it is fun and it is interesting, but that's not the point. The point is that you have a fiduciary duty to people who have entrusted you with your money. And the second thing, which is getting a lot more attention now, is that you're actually a steward of capital, and that the sort of the rise of ESG and sustainable investing is really highlighting that again, it's not about having fun and being interesting. It's about doing your fiduciary duty and being a good steward of capital. And that's sort of my philosophy as investing. And having LIC and a number of different funds that access the retail market is actually very good. It keeps you in check on those two things. So, I met a lady and she's like, well, my parents just passed away and they have given me this inheritance and I think I'm going to put it in your fund. And I was like, I was like, well, first of all, talk to your financial advisor, please. But, knowing that you are looking people in the eye and them saying, I want a dividend because this is what I live off of, or something like that. That is very good for me philosophically as an investor, to remember that this is other people's money and I have a duty to invest it in a certain way.
So let's dig into Asia now as an investment opportunity. You've mentioned there that you're a growth investor, Mary, so I'm assuming that is one of the draw cards for specialty in Asia. But why else are you interested in Asia as an investment opportunity?
Yeah, so maybe I'll just give a few points around the growth story first, because it's not as simple as just saying it's high growth. I think the important thing is that it's structural growth. So you can get growth. In fact, right now you're getting growth in a lot of markets because last year it sucked in a lot of markets. So then if you come from a low base, then you can get growth. But Asia is different. It's a structural growth story in terms of demographics. And, India, which I think we'll talk about a bit later, is a good example of how you're going to, and Indonesia is another one, you're going to get growth just by the demographic change that happens. And then because these are emerging economies or less developed economies, you have a lot of things around that are also structural growth. So whether it's the build out of infrastructure. So, when I first went to some of these economies 20 plus years ago when I started investing, there was no infrastructure. And seeing that build out, provides a backdrop for growth. There's technological leapfrogging. So we're seeing this a lot. We saw it with mobile phones. That's kind of the example I gave at the beginning. You're seeing it now with e-commerce. So I think you go to some developing countries in Asia or elsewhere in the world, and there's no shopping malls. But everybody has a phone, and every country in the world now has some sort of e-commerce behemoth, whether it's Alibaba going in or whether it's homegrown. They're in my view, they're just going to leapfrog that whole build out of shopping mall sort of thing. So, Asia has that technological leapfrogging part of the structural growth story. And then there's just a sort of overall productivity gains that happen in Asia, which don't happen in other markets. So that growth is structural and it's sustainable. And that's why I like it from from an investing perspective. I guess the second thing is valuations are generally lower. So there still is sort of that emerging market risk premium, and we can talk about that later. I have quite strong views on that because, if you look at what's happened in the US and Europe over the last, let's call it 4 years, where everything that happened with Trump and, sort of putting bans on certain assets and, civil unrest in Capitol Hill and a major pandemic that's completely out of control and Brexit and a lot of things that happen in developed markets. If those things happen in emerging markets, they would get absolutely smashed. But they happen in the US and it keeps hitting an all-time high, every day. So I think that valuation discount that gets placed on emerging markets is largely unfounded for certain countries. I'd say like most of North Asia, for example, that's unfounded at this time. So you have the fact that they're growing and like I was saying before, in terms of how you're going to get your upside, they're growing a lot faster and the multiple is lower. So if you take that high growth and you put in a higher multiple, you can get higher forward valuations for the stocks. And then I think the last thing is that Asia is potentially less efficient. So there's sort of more ways to find those inefficiencies than there would be maybe in some developed markets.
So I think Asia is an interesting investing opportunity for a lot of retail investors in Australia and in most Western countries. Are there any key misconceptions you see about the continent and investing in the continent from the retail investing community?
Yeah, there's quite a few actually. I guess at the top of the list would be that Asian companies have bad ESG. That is something that I hear all the time. Is that isn't there corruption high, and how can I be sure the accounts are right and stuff like this? So, my view is that companies in Asia, the ESG is not nearly as bad as people think it is. If you actually meet with the companies, particularly in the large cap. The average market cap of my portfolio is $200 billion. So
wow.
when you're up at that end, you're not dealing with sort of family minority shareholder squabbles. You are these are very high quality companies, and the ESG is generally a lot better than people think it is. The flip side of that coin is that I don't think ESG in Australia is nearly as good as people think it is. And things like the Royal Commission and recent things with some of the commodity companies have shown that. So therefore, we put those two things together, and the gap between ESG in Asia and Australia is much smaller than people think it is. I think the second thing is that misconception is that there's extremely heightened political risk in Asia, and there certainly is some political risk. But I've been investing in Asia since in an investment capacity in Asia since the Asian financial crisis, and there are always ups and downs in politics, and things generally continue to go up. And there's ups and downs in politics in Europe and the US also, and it's a bit of a double standard. That isn't a reason not to invest in those countries, but people use it as an excuse not to invest in Asia. And then I think the last misconception is for domestic retail investors is that they think they can get exposure to Asia, enough exposure to Asia via domestic stocks. So they say, I don't need to invest in China. I own Rio and BHP. And if China's doing well, these companies will do well. Or, I own, some milk company and it is selling lots of infant formula and milk to China. So, I'm covered. And I think that is a very simplistic view of Asia. So obviously, I think one of the best reasons to invest in Asia is because of the technology companies there. And you are not getting that sort of indirect exposure by investing in in Australian commodity companies or Australian consumer companies that sell to China. And, so that, and also, China is just one country in Asia. That's the other thing which bugs me, to be frank, is that people are saying, well, I have indirect exposure to China. And it's like, well, but there's 13 countries in my benchmark, and they're all very different. And so just having indirect exposure to one of them does not count as Asian equity, like sufficient Asian equity exposure in my view.
We're probably going to, even though you've said that about China, we're probably going to focus mostly on China and India in this discussion. Yep. But of those 13 countries, outside of China and India, which one do you get most excited about?
Oh, that's a good question. So I'll give you a long-term view because things are a bit weird now because of COVID. So when I say I'm excited, it's not like I'm excited, about investing there tomorrow. Yeah. I think obviously Indonesia has a lot of potential because it's a very big country. It has a very young population, has a lot of sort of demographic similarities with India, and there's some really interesting companies that are coming up. So Gojek is one, and they're merging with Tokopedia, and they're going to list possibly through a SPAC, or they're definitely going to list in the US. And to have that sort of first unicorn coming out of that's really exciting. I also quite like, again, not right this moment, but in general, I like the Indonesian banks. I mean, if you look at the credit penetration in countries like Indonesia, it's very, very small. And if you look at the opportunities for technological leapfrogging in Indonesia because of the geography, like there's so many islands and you don't want a bank branch on every single island, so it's very efficient to have digital banking. So I think there's a lot of opportunity there. Korea and Taiwan are they're not really emerging markets, but obviously they're still part of Asia. But the technology supply chain and the growth of mega cap technology companies in Korea and Taiwan is a dominant feature sort of Asian equity in markets. And so I think that's not a new story, but sort of the dominance of those two countries in terms of technology is not going away anytime soon.
So we did have a question from our community around the political stability and investing in Asia, but I feel like you've kind of touched on that in terms of not really worrying about it, given that it happens all over the world. So let's move on to some of the major industries and sectors in Asia. What are you kind of focusing on at the moment?
So I started the fund almost 6 years ago now, and there's 3 core sectors, and there always has been, and there probably always will be. So they're technology, financials, and consumer. Okay. So those are the 3 growth sectors. Together, those typically account for 80 to 85% of my portfolio. And part of that is because, in my process or looking for growth companies, those sectors are the ones that fall at the bottom of the process because they meet all our growth criteria and our high quality criteria and our valuation upside, all the different things that we're looking for in the companies that we invest. But I think there's reasons why they fall through, which are worth going through. So technology, Asia is a technological powerhouse. And you've seen sort of with the rise of the Tencent and Alibabas of the world that China really sees technology as a way that they're competing with the US. And it was probably about 4 years ago now, it was in the middle of the trade war when Trump was going really hard on the trade war. And we actually wrote like sort of a white paper about this, saying that it's not actually a trade war. This is like about technology. At the end of the day, this is going to be about technology, and that is going to be the determining factor with respect to the pace of American hegemonic decline versus the rise of China. So I think that that's a really exciting reason to invest in Asia, and especially for Australian investors, it offers diversification because there aren't that many very high tech, large cap opportunities domestically. And the feedback that I've heard from a lot of investors is that they already own FANG, and they have for a long time now. So to increase your exposure now and diversify that technology exposure, Asia is a really, really good way to do that. I guess the second is consumer. So, you have 2 countries in Asia that have over 1.2 billion people. And for a small market like Australia, that is just, the opportunities that many people, like just bodies on the ground and what they're going to consume as those countries continue to develop is really, really powerful. And then financials. So when I was at Soros and Oaktree, I was the financials analyst. So financials is kind of like my pet, my pet sector. And the reason I like it, well, I like it globally right now, frankly, because during COVID, a lot of financials and a lot of financial company management thought there was going to be a huge COVID NPL cycle. So they all did major provisions, and then that NPL cycle has not shown up. So now they are either having very small provisions because they've over-provisioned before, or there's even some scope in certain countries for there to be write-backs. So that's a very positive part of the financial story. And then also, interest rates, they're certainly not going any lower, so they can only be flat or up, and that's generally positive for financials. And also right now, as I'm sure you've talked about on other shows, you're seeing a rotation out of some of the higher, like growthy, extremely expensive names into lower PE names, and financials generally fit that bill. Like the average PE of my tech portfolio is probably 30 times, and the average PE of the financials in the portfolio is probably 11 times. So for that reason, I'm massively overweight financials now. But in general, in Asia, financials are good because credit penetration is so low in Asia. So like in India, mortgage penetration is 9%. So they could grow mortgages at 20% a year for many, many, many years, and they're not going to run out of people who want a mortgage. And so overall, like putting that together, I think financials is a really interesting sector. So it's tech, consumer, financials.
So we've touched on the fact that there are two countries in Asia with over 1.2 billion people, China and India. By 2050, they're expected to be the two largest economies in the world, so both of them to leapfrog the US and everyone else. How do you compare and how do you think about these two countries from an investment perspective?
Okay, that's a great question because people often ask me, is India the next China? And I say, no, it's the first India. It's not going to, to think that India is on the same development pathway as China, but it's just a decade behind maybe is not the right way to look at it. So I don't like starting with a negative, but how I look at it, that's certainly not how I look at it. I look at them as, and I do have a background as a development economist, so I certainly recognize the developmental paths of these two countries, and they're not the same. And to sort of the earlier question that the reader had before, obviously India is the biggest democracy in the world, or the listener had before, India is the biggest democracy in the world and China is not a democracy. So right from the get-go, you have two totally different countries. But the way that I look at it is, from a macro perspective, I think you need exposure to both. So, I have this slide in one of my presentations that's like Asia is too big to ignore. And I think that for both of those countries, if you think of what you said at the beginning, that by 2050, they're going to be the two largest economies in the world. The last numbers I looked at, which are maybe a little bit off because of COVID, but by 2030, it's expected that China is the biggest economy, then the US, and then India. So you have two of the three largest economies in the world are in Asia. But when you ask people about their portfolios, they generally have no exposure or very little exposure to either. So I think at some point people need to get their head around the fact that these are massive economies and you're going to need to have exposure to them. And then other than that, though, one of the things that I'm hoping is more similar between the countries is that you've seen the rise of these huge mega cap tech companies in China, and thus far you haven't seen that in India. But I think we can talk about that later. There is a very attractive IPO pipeline in India, and we're hoping that there's a homegrown Tencent and there's a homegrown Alibaba, and there's certain supply chains and things that list in India or companies that become very big in India, so that it's similar to China in terms of those mega cap tech companies.
Yeah, we are very excited to get into that and some of the company specific stuff. Before we do, with China and India, the demographic story is the big conversation, and you spoke about that earlier in terms of structural drivers. And there's this saying, demographics is destiny, and people sort of think it's almost preordained that all this development will happen because of the demographic mix. But I guess, China has seen a lot of that growth. India, not so much. There's a lot of potential growth there, but it's not, I guess, guaranteed. What makes you confident that India will be able to realize the potential that their demographics offer?
Yeah, okay. So that is a very good question. And before I answer it, I'll just say, obviously I am aware that India is going through a difficult time right now, and that COVID in India, certainly the second wave has been absolutely devastating and will continue to be for at least the next few months. So the comments that I say are with a longer term perspective, not as like what's happening right this moment. So I get asked that question a lot because people say India always looks like it has a lot of potential, and is it delivering? And to be frank, when I first started investing in Asia and emerging markets, India was not my favorite country, even though those demographic building blocks were there. And one of the main reasons was they didn't have the policy environment in place, they didn't have the political leaders in place, and they didn't have the leadership there to sort of take India on the path that it needed to go on. So remember, like historically, India had all this import substitution, and they still have a big current account deficit. They have to import a lot of oil, and it was just kind of a bit of a macro mess. And I think that in 2014, when Prime Minister Modi was elected, that really changed a lot of things. So, he did a lot of very bold policy changes, whether it's like demonetization or introduction of the GST or reform of the banking system. I mean, these sound boring, but they're actually, for a country like India, they're actually really important to get right. So I think that having the right political leadership is absolutely critical for India achieving its potential. The train is moving no matter what, but if you have a good conductor, like it can just move a lot faster, and that will be much better for India's long-term development. I think the other thing that's important to highlight about India is that there are all these big companies like Infosys and TCS, which they're like almost 100 billion or over $100 billion market cap companies now. And they have an expertise in IT services. And India is also the biggest manufacturer in the world of pharmaceutical products. So a lot of people don't appreciate this about India. They think it's the consumer story, and you want to buy like Nestle and Hindustan Unilever in India because there's all these Indians that are going to be buying, more stuff as the economy develops. But it's important to highlight that India's actually been very, very successful in actually exporting different products too. So back to your original question, that's one way, and it's completely different than China. China went down the sort of manufacturing route, and India is like services, IT and pharma. So yeah, I think India needs the right political leadership, and Modi, it'll be interesting to see how the population responds to his handling of COVID. Because as you may know, there's state elections going on, and that's part of the reason why the infections have gotten so out of control, is because he just kept on campaigning and kept encouraging hundreds of thousands of people to go to rallies. And the criticism, which I actually agree with, is that he has put winning state elections over the health of Indian people, and whether that comes back to haunt him in the next election is yet to be seen.
Mm-hmm. So, Mary, we're interviewing someone on the show soon, David Halpert from Prince Street Capital. He has this thesis around digital decolonization and how the big US tech companies have basically colonized the world, and that a lot of countries are now decolonizing in some ways, and they're seeing their own sort of platforms, payments platforms, social media platforms, sort of push the US giants out. Is that a trend that you're seeing in Asian markets?
That's very interesting. I'd never thought of it that way before. So in China, definitely no. So China has had the wall up, like nobody's getting in. And that is part of the reason why you've had the ascent of the Tencents and the Alibabas, and even now the PDDs and Meituans. I mean, you have like half a dozen Chinese internet and tech-related companies that have market caps of 200 billion plus. So yeah, it's easy to thrive when there's a big wall up that's not letting in your international competitors. So I'd say China, definitely not. I think for and Korea, I would also say definitely not. So Korea, there's a company called Naver, which we own, which is kind of like the Google of Korea. There's another company called Kakao, which is kind of like the Tencent of Korea, and it's spinning out. It has this like Kakao Pay and Kakao Bank. So there's, I would say no in Korea. Part of this may also be language. So you have countries that have a completely different language and have like the right, like they don't use they have a different, like they have characters instead of letters. That could be a big barrier to entry to some of the US funds, or the sort of US tech companies. In ASEAN, I would say that is probably true. And in India, I would say that sadly, that is definitely true. So I think Facebook is like India's second biggest market in the world, or something like that. And I even notice, so almost all of the broking and interaction with brokers and sell-side analysts in India is all on WhatsApp. So it's very much a Facebook, WhatsApp sort of market. Yeah. And whether, Reliance and Reliance Jio can combat that at this time, it's not exactly the same, but that's a question that remains to be seen. So I would say it differs across Asia. India is probably the one that's been colonized the most, and China is the one that's been colonized the least. Yeah.
Well, let's chat about Reliance and Jio, but before we do, we'll just take a quick break to hear from our sponsors. So, Mary, any conversation about Indian companies obviously has to start with Reliance. Its ticker is RIL. It is India's largest public company, and it has been of interest to many Western tech companies, Alphabet, Facebook, Microsoft. What is the opportunity with Reliance and its subsidiary Jio?
Okay, so I say that the opportunity is threefold. First of all, Reliance is a conglomerate, and it has three main parts. So the first is sort of their old, boring business, which is like petrochemicals and energy. And people are like, oh, snooze. But it's actually important in terms of the other two segments, because this was a cash cow, and it allowed them to continue to spit out cash every single year, billions of dollars of free cash flow, so that they could invest in Jio and invest in retail and bring them up to the size of companies that they have now. The other thing I'll mention about the boring bit is that Saudi Aramco is taking a stake in it. And, MBS, the prince was on CNBC recently saying, the deal is going to happen very soon, like probably in the next 3 to 6 months. And so the fact that, Saudi Aramco is buying into their energy assets is a big sort of tick in the box, because if anyone knows about energy assets, it's the Saudis. So that's the business that nobody really likes, but it's still very important. Okay, and then the Jio business, basically they had nothing about 5-6 years ago. They had no foray into telecom at all. It was not one of their core businesses, and they spent tens of billions of dollars building up a mobile phone network basically from scratch. And now they have over 400 million subscribers. So to do that in such a short period of time is amazing. And part of the way that they did it was that it was loss leading for quite a long time. But when you have this cash cow spitting stuff out, you can do that, which none of their competitors had that option. So they just really like cleaned up the competitive landscape. So now when you meet with Reliance IR and talk about Geo, they say that they want to be the Tencent of India. And again, that kind of bugs me. It's like, is India the next China? Just like be your own thing. But I think what they mean by that is that they want to be an ecosystem. So the thing about Tencent and Alibaba is that they're ecosystem stocks. So once you're in WeChat, then you get offered all this other stuff. It's kind of like being in the Apple ecosystem. Once you're in, you're not going to go get a Samsung phone.
Yeah, we've spoken about super apps a little bit on the show and in our Thought Starters email. And yeah, I guess WeChat's the perfect example of that.
Yes, exactly. Yeah. So I think that's what Reliance, they don't maybe really want to be Tencent in terms of they want lots of revenue from gaming, but they just want to be an ecosystem. And thus far, they are doing really well at that in terms of the other apps that they're offering and the sort of connectivity between the different businesses. So I think that's going to be very powerful. And then the third business is retail, and that is the synergies between retail and Geo are very strong, because if, like I was saying before, if everyone has a phone and you're actually the biggest retailer, the opportunity for e-commerce is very strong. So those two businesses, Geo and retail, are going to get spun out from Reliance sometime in the next 2 years. So Geo will probably go first. It's anticipated later in 2021 or in 2022, and then Reliance Retail will go after that. So, and these, once they get spun out, the estimated market caps are going to be very big. So Geo is supposed to be around 70 billion US, and retail will be about 60 billion US. Wow. And so these are like, to be spun out at that size is really amazing. So that's the operational opportunity for Reliance, but the investing opportunity is that when these companies list, they're going to trade at much higher multiples than they're trading at within Reliance. So we do some of the parts all the time on Reliance. And if they list at 60 or 70, and if Saudi Aramco comes in at a valuation that's higher than what's in your sum of the parts, then the current Reliance stock will go up because that sum of the parts is going higher.
So you mentioned retail there, and if we stay in India, a big e-commerce battle is, I guess, underway. Amazon in India, and then Flipkart, which is owned by Walmart, is also there. And I guess they're really going head to head for supremacy in the Indian e-commerce market. How do you think about the state of e-commerce in India? And Flipkart, I think, is about to IPO. So if you have any thoughts on that proposed IPO, we'd love to hear them.
Yeah, so I guess there's a couple things. One is that they are going head to head. And to get back to Bryce's earlier comment, the fact that Alphabet, Facebook, and Microsoft have all invested in Reliance, and that Walmart has bought into Flipkart and they're going head to head with Amazon, this shows you that when the CEOs and the head of strategies at these big global tech firms looking around the world, their eyes have all ended up in India at some point, because there is no other market in the world where there's one company that all those big competitors from the US have gone in. And like Walmart, this is one of their biggest forays into e-commerce anywhere. And that, like, they could have done it anywhere in the world. They could have done it in the US, and they chose India because that's where they see the sort of opportunity set. So I think the thing is that one thing to highlight about Amazon and Flipkart is that India is a massive market, so it doesn't have to be winner take all. There could definitely be room in a country of 1.2 plus billion people, and one of the largest economies in the world for two major e-commerce players. The other thing I'll say is I actually did a study for an organization called Asia Business Link, and their sort of mandate is to help Australian businesses succeed in Asia. So I did a study for them about how multinationals have succeeded in India. And it is a difficult market to succeed in if you're a multinational. It is very, very localized. So one of our companies, Hindustan Unilever, it's obviously Unilever's company in India. They have this whole strategy called winning in many Indias. And they break India down into, it's not even by the state. It's like, this is a massive country, and you can't think of it as a massive country. You need to think of it as like many, many different smaller countries. And I think there are a lot of examples of multinationals or big US companies that go into India and they don't understand the they don't understand that India is different, and they don't understand that there's lots of different Indias within India, and they just fail and pull out. A lot of the auto companies are good examples there. So I don't know how Amazon is going to do, to be frank, but it's much harder to be an outsider coming into India and trying to succeed than it is to already be on the ground. So the Flipkart IPO is supposed to come sometime. There's no time frame on that. Like Reliance and Jio, it's pretty confirmed when they're going to come. But it's estimated to be around $25-30 billion. So again, these are not like little microcaps that are listing. They're listing at very big valuations, but that's something that we will definitely be interested in participating in when it does happen.
So given we're talking about, big tech companies and, sort of multi-billion-dollar market cap companies, if we move to China, we've touched on a few in this conversation: Tencent, Alibaba, but there's Pinduoduo, Meituan, Baidu. Like, these are massive companies in their own rights. Most of them are pretty heavily localized in China. How do you think about the international opportunities for a company like Tencent or a company like Baidu? Like, do you think they will break out of China, or do you think they will be domestically focused tech companies?
I think they will continue to be domestically focused because there are so many, so they have their ecosystems, and then they have different verticals, and then they have so they can go down and they can go out, but they can continue to go down and out without leaving China. So for example, I'll give you Baidu as a company that I own in the portfolio right now. I didn't own it for a really long time. So it's like the Google of China. And it was just kind of like a boring search thing, and ad revenues were going down and there was no reason to own it. And they have recently gone into the electric vehicle space. So they have partnered with Geely, which is one of the domestic, auto OEMs, and they are providing sort of like the tech for automated driving, and they have a huge cloud business, and they have all these other sort of ancillary businesses to search, which are not currently in the valuation, which make it really exciting at this time. If you look now for Alibaba and Tencent, cloud is a major driver. So these aren't, like for Tencent, games is still the cash cow, but there's other things that are growing much faster. Similarly for Alibaba, PDD and Meituan, they right now are going very, very hard into grocery. So Meituan did a $10 billion equity raise earlier this week, and they said we're spending $6 billion a quarter to get to do a land grab in grocery. Wow. And so if they're doing land grab in grocery, well, Alibaba is going to have to do it also, otherwise they'll lose market share. So I think that there's still so much going on in China that they don't really need to go elsewhere. That's operationally. But one thing I will say is that you should Google it if you have time after, but there's this like Harun unicorn list where this organization goes through and like ranks and lists all the unicorns in the world. And they also have part of the report which looks at what are the biggest VC funds in the world. And actually Alibaba and Tencent are not only two of the biggest tech companies in the world, they're two of the biggest VC companies in the world if you define that as investment in unicorns.
We did a deep dive on Tencent at the start of the year, and we found a spreadsheet that someone had put together where they tried to list as many of Tencent's VC investments as possible, and they estimated there was up to 700. I don't think there's a full list anywhere, but we're going through the list and it was like, buzzy companies like Roblox, Afterpay, like they might be a Chinese operator, but they are investing globally.
Yes, exactly. So that's I think that the internationalization will happen more from an investment perspective than it will from an operational perspective.
So Mary, you've spoken a lot in recent presentations about the IPO pipeline in Asia. Why are you so excited about it at this time, and how is it different to the IPO pipelines elsewhere?
Yeah, so I'm super excited about it. So I've been covering Asia for 20 plus years. I've never seen the IPO pipeline this hot or this exciting. So part of the reason is because they're all new economy companies. So when I first started doing Asia, the IPO pipeline was like, the national bank is getting privatized. And you're like, ooh, woohoo. Or, there's some big state-owned, the state telcos. This was a big thing in like the 1990s and the 2000s. The state telco, it was like Telstra and CBA. There were tons and tons of IPOs like that. And, that's fine. That's great for the countries that those sorts of companies are listing, but it's pretty boring for the investors. So the IPO pipeline now, one thing I'll say is that the kinds of companies are very interesting. So it's very, very tech heavy, as you would expect. And as I was saying before, in terms of like diversification for Australian investors, that's really attractive. So some of the ones that we've had in the last 6 months are JD Health. So that's a spinoff from JD. and it's like the online pharmacy, and they have some other businesses, but primarily like online pharmacy of JD. And that was a very very attractive IPO. And then Kuaishou, which is the second biggest competitor to TikTok and ByteDance in China, they also IPO'd. And these companies are IPOing at like $50, $100 billion plus sort of market caps. So that's the second thing that I'll say, is that these are not small caps. So, we have a small cap and a micro cap team in Australia, and I look at some of the deals that they're looking at, and then I look at these companies that literally, like for example, Kuaishou, they did a pre-IPO round of, I think it was $4 billion, and you had to put in $300 million. That was the ticket size.
Wow.
And so these are really big companies. And the thing to specifically answer your question that's different than before is that when you have small IPOs, maybe they're interesting companies and maybe they're hot IPOs and you participate, but when they list, if they're a $5 billion market cap, they're making no difference to your benchmark at all. And as I'm benchmark independent, but the whole point is to outperform the benchmark, right? And so the difference with these companies is that when they list, if they list and their market cap is $150 billion, they get on the benchmark right away. MSCI says we're doing a special entry thing, and a week from now, it's going to be a 2% weight. So like Meituan, it hasn't been listed for that long. It's already almost a 3% weight in the benchmark. So this is very different, because as an investor, you need to be looking at the IPOs, not just as IPOs, but as companies that are going to be in your benchmark straight away. I think the other thing that's really exciting about the pipeline is it's not just China. So there have been, obviously China, Hong Kong Exchange is one of my biggest overweights, because you were just going to see massive, IPO pipeline out of China. But if you look at the unicorns, there's Coupang, which is sort of the JD Alibaba of Korea, listed earlier this year. Again, it listed at 56 and it went up quite a bit. So it's, very big market cap company. You're seeing Gojek and Tokopedia, which we already talked about. You're seeing, Grab from Singapore, which is kind of the Uber of Singapore. So it's not just, and then all the Indian ones, which we've also talked about. This is not just a China pipeline. It's actually quite pan-Asian, and I think that's exciting.
Yeah, you mentioning some of those companies, you do start to realize just how big the opportunity set is there. One potential IPO that I think would make the world extremely excited, it would definitely make Bryce very excited, because he's a big user of this company's product. Do you think ByteDance will IPO?
I do. Yeah, I definitely think that they will IPO. And this whole, what I was talking about before in terms of political risk and the double standard. Like, Trump just didn't like TikTok because it screwed up one of his rallies. So he went on this rampage about trying to ban TikTok and stuff. So I think that ByteDance, it is going to IPO. In terms of the expected valuations, it's anywhere between 200 and 400 billion.
Jeez.
But even if it's, like 400 billion, what kind of companies IPO at 400 billion? Now that could be a crazy, we don't have enough information on the financials right now to know whether that's true or not. But regardless, even if it's the low end of that range, that's still really big.
A trillion.
Yeah, like.
Well, that's.
You missed the IPO. It's like.
So with the way that we're looking at IPOs, they're obviously super competitive. So it's not like you say, oh, I'd like $100 million of the IPO and you get $100 million. Some of the brokers have told me that they look at all the people who want to participate and they cut the list in half, and the bottom half are zeroed out straight from the get-go. And the big accounts at the top, who are like, the global sort of behemoths in fund management, they will get a decent allocation, and everyone else in the middle is fighting for the scraps. So I'm in the fighting for the scraps part of that thing. But as long as you get a scrap and you've done the hard work, like this is what we did for Kuaishou and JD, is that you've done the work and okay, this is a company that I want to own long-term. I'm not in this for the IPO flip. Then you're buying more on the first day. And what the IPO gives you is a lower average entry price. So in terms of where you go from there, there's a lot of upside and build out for these companies. And if you can get any participation in the IPO, it's just helping your return later on.
So there's no doubt that the Asian opportunity is massive, but for a retail investor, getting access is becoming easier, but still not as easy as if we were to buy into the US or whatever it might be. From your point of view, what advice would you have for retail investors interested in the Asian opportunity?
Yeah, so it is getting easier. Part of the reason why we have an LIC and also a unit trust is because people want that liquidity. So they want, I want to be able to invest in Asia, but I want daily liquidity. And so that's part of the reason that we have an LIC. And I think we've gotten very positive feedback on that. The second thing I'll say about having an LIC is we do have a decent dividend. So like I invest in growth stocks, so you wouldn't expect me to have a dividend, right? Because there's no dividend pass through. But Asian markets have gone up a lot since we started, and I've realized a lot of profits. So if you go in via an LIC structure, you can get both that upside and our dividend yield right now is around 4.5%. Okay. So that's quite attractive to a lot of people. One thing I will caution your listeners about is, in addition to the people who say, oh, I don't need to invest in Asia, I have, BHP and A2 Milk, are the people who say, I just bought Tencent and Alibaba and I'm done. That's my whole, okay, those are amazing companies. They're two of the biggest weights in my portfolio. I get that. I'm not at all disputing that. But to get access to everything, all the exciting things that are going on in Asia, you need a diversified portfolio and you need someone who's watching it all the time. So just to invest in those two stocks, and I think a lot of people got burned because Alibaba actually had a terrible November to January, and it's still sort of, the stock price is languishing down at around that level. But I think it highlighted to a lot of people that Asia is a complicated market and you can't just try to play the whole thing and all the thematics that are going on in all the countries by buying two stocks, which are actually very similar in one country.
And just a reminder that, Mary, your fund, the LIC that you're talking about is the Ellerston Asian Investment Fund, and its ticker is EAI. Yeah.
To just finish up on your question, India is a very difficult market to invest in. And that's part of the reason why we have an India fund, because you cannot open up a PA account. India, unlike China, has very, very few ADRs. There's like Infosys and, one bank and one loss-making travel company. So you really, again, you can't get a portfolio by buying ADRs. So that's one of the reasons why we started the India fund. A high net worth investor came to us and said, every other market in the world, I do it myself. I can't. It's just all too hard in India. So please start a fund, and it's sort of grown from there. But I think there's a large spectrum in Asia of markets that are easy and difficult to invest in.
That's the kind of scale that we need, where we can go to a professional fund manager and say, I want you to start a fund on this thing that I'm interested in.
Yeah, the Equity Mates community want an Indonesia-specific fund.
Yeah, well, you know where to find me.
We've got the scale.
So one other question for the retail investors, and this is definitely something that I've grappled with, is when we're talking about a country like India or just maybe emerging markets more generally, a lot of people default to market cap weighted indexes because that's what's available on exchanges in, Western countries like Australia, the UK, the US. How do you think about an indexing approach in a country like India?
Okay, so I don't have a problem with market cap weighted at all. In fact, I've thought a lot about this. And unlike some developed countries or emerging markets, say maybe 20 years ago. So if you were to look at emerging markets 20 years ago, the largest market cap companies would be the privatized oil company, the privatized bank, the privatized telco. And those are not the best stocks in the country. They got to be that way because they had some government support, and then they just IPO'd and they were big. And Australia actually kind of fits that category too. If you look at, many years ago, what were the largest companies? But what's happened now is that the companies that are the biggest market caps got that way because they're the best. And so if you look like Samsung in Korea, yes, of course it's 35% of the Kospi or whatever it is now, because it's like an absolute behemoth, which has just, been incredibly successful. And TSMC is the same thing in Taiwan. Yeah, it's the most amazing semiconductor company in the world. And, Alibaba and Tencent, which we've talked about a lot, or Reliance. So these, I've debated this because I do hold a lot of these companies in my portfolio, and people say, well, if you hold these large cap companies, then you look like an ETF. And I have two responses to that. One is I have the same, there is some overlap between the stocks that I own and what you would own in a market cap weighted ETF, but I generally own way more. So like, for example, if Alibaba was a 5% weight, I've had up to 14% of the portfolio in it. Or if Reliance is I think it's a 1%, maybe 2% weight now, I'll have up to 5% in it. So part of it is if you like these large cap companies, you can invest in them even more than you would in a passive. But I think that the bigger thing to your question is that, so people say that there is one fund who's one of my competitors and they don't buy any of those big ones because they're like, I don't want to look like an ETF. I'm just buying forget about market cap weights. I'm just buying the companies that I like. But my response to that is that these companies got to be the biggest market cap companies in Asia and in the world because they're the best. So why would you run an Asia fund where you're purposely not buying the best companies? Like that is completely insane to me. So I don't, the short answer to questions, I don't have a problem with market cap based. And I think we actually did a lot of analysis of this before we started the fund and made the decision to focus on large caps. In Asia and emerging markets, your risk return on small caps is very bad because you have higher liquidity risk by definition, you have way higher ESG risk, and you generally don't get the returns. And so for me, large cap is better risk reward. And if that means that you're more market cap weighted, so be it.
Yeah, and it feels like the conversation we've just had, a lot of the highest growth companies aren't listing as small caps and going on a public journey to becoming these large monsters. They list as the biggest companies in the index.
Yeah, absolutely.
Yeah. So, Mary, we want to thank you for joining us today. I reckon we could have done another couple of hours talking about some of these countries. Well, there's countries we didn't even touch that are in your remit. So we'll have to get you back. But before then, if people want to read more about what you've done or follow you online, is there anywhere in particular they should be going? Any social media you're particularly active on?
Yeah, absolutely. Well, you can always go to the Ellerston website. That has all the information on the funds. And I do write a lot and obviously write a monthly for all the funds that I have. So that's one area. Or feel free to contact me on LinkedIn. I'm happy to chat and be in contact with people on LinkedIn.
Nice. So we do like to end these interviews with the same 3 questions. So we'll get stuck into those. The first one is, do you have any books that you consider must-reads?
Okay, so I thought about this a lot because you sent me the questions last night. And I was like, do I want to sound like an anti-intellectual on their show? So I'll be honest with you. And I know that you have the thing on your website that's like books that you're recommending.
Yeah.
So I purposely try not to read books about investing. And do you know what the reason why is? Because, so like, to use an exercise example. So I do lots of different things. I swim every morning, I run, I do yoga, I do Pilates, and it's, that diversification and cross training is really nice. And I feel like for my brain, like I wake up in the middle of the night to check how my ADRs are trading. And then the first thing I do when I wake up is check how the ADRs closed or how they're trading when I get up. And then I get in the car and I listen to podcasts or I listen to Bloomberg Daybreak, and then I spend all day thinking about equity markets. And then I go home and give my kids dinner. And if I like snuggle up with a book about investing, like that is just terrible.
Yeah.
So, and I think like my brain, similar to like doing yoga, Pilates, running and swimming, like your brain needs other things. So I read a ton of fiction, which my husband gives me a terrible time for. And he's like, there's so many interesting things going on in the world. Why would you read things that are made up? But anyways, I read a lot of fiction. I read a lot of historical fiction that takes place in Asia. So you're sort of learning about history at the same time. And yeah, so no, I don't have any books to recommend.
That is fine.
It's the short answer.
That is fine.
That is fine. The next question, which we're trialing this year, in 60 seconds or less, what's the best company you've ever come across?
HDFC, which is an Indian financial. And the reason is it ticks every single box. I think it's the best run financial in the entire world. If you look at their cost to income ratio, if you look at the way that they manage their NPLs, if you look at the stability of the management team, if you look at, sort of every single metric that people would use to identify a quality company in the world, it ticks all those boxes. And then you have the added benefit of, it's a mortgage company in a country that has 9% mortgage penetration. So it can continue to be an amazing company for 50 years from now.
Wow.
So that's what I'd say.
Wow, company I've never heard of.
Yeah.
I'm really glad we added this question in. We're getting some really
Some good
interesting answers. Yeah. And so then final question, if you think back to earlier in your career when you were at that lunch with Howard Marks or meeting George Soros for the first time, or just starting out in your career, what advice would you give to your younger self?
So it's a very good question. The first thing I would do is not actually give myself advice, but I would congratulate myself on taking risks. Because when I was younger, I took some crazy risks. Like I think back and like, what on earth was I thinking? So I'll give you an example. So I was an investment banker in New York, and I won some international experience before I went to business school. Because you have international experience, you have a much higher chance of getting into a good business school. So Solomon Brothers at the time was like, well, why don't you go work in our Moscow office? So, that's a bit random. It was like late 1990s. I don't speak Russian. Okay, so that was an option. And then there was another investment bank that was in Azerbaijan. And they had headquarters in Baku. And they were like, oh, why don't you come work for us? And I thought, my parents are going to absolutely freak if I say I'm moving to Azerbaijan. So I told them the Azerbaijan one first. And they were like, oh, they did completely freak. And then I said, oh, actually, I have this other opportunity in Moscow. And they're like, oh, definitely go to Moscow. And it seemed like a much better option. But I did some random things, and I went to China and worked for VC China, even though I don't speak Mandarin, and I spent a year living in Africa. And so I think for people when you're younger, take risks, because it's a great time to do it. So now, I have 2 kids, and my husband and I both have our careers established here. It's not like we're packing up and moving to Azerbaijan anytime soon. So the first thing I'd say is well done for taking risks, because the older you get, the harder it gets to do that. The second thing, to my younger self, I would start investing a lot earlier. So we were talking before the show that, I have a 14-year-old son, and he has started investing, and he's already learned things, which I wasn't learning until I was in my 20s. And I think the sooner you do it, the better off you are. And I think, I know you guys have a relationship with Sophie and Maddie in terms of you're in good company. And I think that sort of, particularly for women, because the investment gap, if you don't start investing early, can be absolutely huge by the time you're ready to retire. So that would be my main advice to my younger self, is start investing sooner, because you learn something every time you make an investment, and the earlier you start, the more you'll learn.
It's crazy the amount of experts that come on and have that as their piece of advice, is just get started as soon as possible.
Yeah, exactly.
Mary, thank you very much. It's been a truly fascinating conversation. As Alex said, plenty more to unpack, so we'll definitely have to get you back on it at some point to continue the discussion, but appreciate your time. I know there was a lot of value that our audience would have taken from that, so thank you for your time today.
Great. Thank you so much for having me. It was a pleasure.
Thank you.
Equity Mates Investing Podcast is a product of Equity Mates Media. All information in this podcast is for education and entertainment purposes only. It is not intended as a substitute for professional finance, legal, or tax advice. The hosts of Equity Mates Investing Podcast are not financial professionals and are not aware of your personal financial circumstances. Before making any financial decisions, you should read the product disclosure statement and, if necessary, consult a licensed financial professional. Do not take financial advice from a podcast. For more information, head to the disclaimer page on the Equity Mates website, where you can find ASIC resources and find a registered financial professional near you. In the spirit of reconciliation, Equity Mates Media and the hosts of Equity Mates Investing Podcast acknowledge the traditional custodians of country throughout Australia and their connections to land, sea, and community. We pay our respects to their elders past and present, and extend that respect to all Aboriginal and Torres Strait Islander people today.